Hello, hello, hello. What's going on, everybody? Hopefully you guys can hear me loud and clear in the YouTube world. Looks like everything is good, so we're going to jump right into it. So, welcome to a Capital Hungry Market Update and Trade Ideas webinar. But, as we are starting out a new business month, and of course a new business quarter, coming into the last quarter of the year, Q4, I just want to give a quick educational review on market timing and market waves. Okay, so we're going to jump into that first. Then we'll look at what fundamentals, economic events, and so forth that we have, as well as trade ideas across the board. But first, recent key fundamental points that we have been playing is we have to understand we're just starting out Q4, a new business quarter. And as we're starting out this new business quarter, and we've had very strong movement the previous months, we're seeing markets in secondary phases of structure, either in corrective, pullback, or consolidation phases. The macro information advantage of central bank policies is still holding the most weight, but markets move in waves, and we have to adapt to these waves accordingly as we jump back into the higher time frame trend when we reach price points of interest and have the confirms that allow so. Okay? Focus on a lot of economic data this week, and majority of geopolitical tensions from Russia versus Ukraine, from China and Taiwan, political issues so far, is noise and not holding that much weight at all. From a psychology perspective, we have to adapt to the market waves. As the markets move in waves, we have to adapt to these waves accordingly. We're having pullbacks and price setup phases to start the new business month and quarter. That means us as manual retail traders have to adjust our risk, psychology, and execution to the market waves accordingly, while also keeping an eye out on the higher time frame analysis and price points of interest to jump back in with the main trend. Okay? So, for example, let's break it down here. Let's look at gold here. Gold, obviously, since the start of the year, has been extremely bearish. The reason why gold has been so bearish here, if you understand the fundamentals at play, is of course what's marked out in red. Fed rate hike cycle, inflation priced in, Russia v Ukraine priced in, USD domination, less global investment activity with rate hikes, right? This is the main reason over the course of the last year that we've drove down from 2,060 an ounce all the way to 1,600 an ounce. And I want you all to notice something very, very interesting here. As we have sellers print significant lower lows, we have very, very common pullback phases that occur in this overall broad bearish market structure. You can also see that you almost conveniently sometimes come to revisit previous significant highs or lows as major sell side liquidity zones before still continuing down bearish on the higher time frame, right? So with a lot of the geopolitical tensions priced in, as when Russia was first invading Ukraine, that's what led to this surge to revisit all the way to the 2075 pandemic highs. And then we had the Fed shifting into their active rate hike cycle, bringing more US dollar domination, ending the decade of free money, and also as inflation has been priced in over the last year and the Feds have a single mandate approach to combat inflation, this is the main reason why gold has been driving down. These are also the same exact main reasons why the stock market has been more bearish with the Fed rate hike cycle and dollar domination, commodities more bearish, and even real estate market more bearish. But we have to understand something very significant when understanding the market waves. Of course, the higher time frame is bearish. Of course, gold has been going down overall, but we have to look at something very interesting. Every time we have a successive phase in terms of the main trend with bearish structure, for example here, we had an 1800 pip sell run. After this pullback phase down to here, we had a 2000 pip sell run. After this pullback phase down to here, we had a 1900 pip sell run. After this pullback phase down to these lows, we had a 2000 pip sell run. It is very common when you're looking at the runs of bearish structure in here in sellers in domination that you pretty much have an aggressive sell side move of almost 1800 to 2000 pips on average before starting to create a significant bottom and starting to enter a pullback phase that occurs. Now, what's also very interesting is as we have these pullback phases, they almost last the same period of time. From this low point here that was printed to this pullback phase up here, that was 21 days long. From this low point printed to this pullback phase here, that was 28 days long. From this low printed to this pullback phase here, that was 28 days long. From this low printed to potentially the pullback phase here, we might mess around and have a pullback into the 1720s, 1730s over the next couple of weeks before we finally see sellers jump back into the market and the higher time frame bias back in play. So what I'm trying to explain as a manual retail trader is during these secondary phases of market structure marked in yellow, we have to adapt accordingly. We can't be selling during these phases even though the higher time frame is bearish because we're in a secondary phase of market structure and doing aggressive pullbacks. These pullbacks can run for 500 pips, 1000 pips from significant lower lows being printed, still end up retesting better sell areas, and still maintain overall bearish market structure. And what we also have to understand is the same time we're having this potential pullback phase, as sellers have printed these significant lower lows, is also at the end of a quarter and start of a new quarterly phase. So it's not out of the ordinary at all to see these aggressive pullback phases to almost retest previous significant lows before seeing sellers jump back into the market from better price points of interest on the higher time frame. I also gave a nice breakdown about this on Telegram as well as Instagram as well. And it's not just gold that you're going to be seeing this pattern of price width and potential pullback and corrective phases occur from these significant lows. Anything that has been primarily induced in terms of order flow from the central banking policy sentiment, mainly the Federal Reserve, aka dollar pairs, stock market, commodities, even Bitcoin is probably having a bounce from lows as well, right? Any asset class that has been pegged against the dollar and primarily influenced by the Federal Reserve rate hike cycle and dollar domination is all in these secondary phases of market structure marked in yellow here, having a pullback from significant lows. Let me show you an example. Look at GBPUSD here on the daily time frame. Of course, extremely bearish. Sellers printed new lows. We're having a pullback phase for the new quarter and for the new month. Come here and look at EURUSD. Of course, it's extremely bearish, but we're having sellers print new lows in a pullback phase for the new month. Very, very common behavior as markets move in waves to have these pullback and corrective phases to generate more liquidity before coming down more bearish again, right? You can even see on the US stock market on the daily time frame here, as sellers have printed these consecutive lower lows, even though we're clearly bearish, we're having a pullback phase, order generation and collection, and price setups from an institutional perspective for the new business quarter to close off the month. And outside of that, when you come to look at some commodities, for example, like oil, same type of idea. Very bearish from the highs, but very common from significant lower lows to have pullback phases. Right? So this isn't shaking any of the higher time frame bearish structure. This doesn't mean that the stock market is bullish again now, that we're going to be going back to the highs. This doesn't mean that gold is bullish and we're going to be going back to the highs. We still have more Federal Reserve rate hikes to come. we still have very strong bearish market structure across the board, but as manual retail traders, what we are adapting to is a potential pullback phase. Does that make sense for everybody? There's not going to be any Fed pivot. The Feds have no choice but to bring down inflation. Otherwise, inflation will get out of hand and become an economic crash catalyst in itself. The Feds are going to keep rates up. All we're seeing is short-term corrective pullback phases. And look at the trend here. Every single time you have 1,800 to 2,000 pips of downside, you also have a pretty correlated pullback that lasts roughly 3 to 4 weeks before overall collecting more sell side orders and continuing bearish again. Isn't that beautiful? Is this not beautiful? Right? So bringing this information together to the table right now, gold could easily still pull back to the 1720s, 1730s on the intraday time frames and still be very, very bearish. You can see none of these pullback phases have ever broken us out of this higher time frame bearish market structure. It doesn't matter if there was noise with Taiwan and China. It doesn't matter if there was bad short-term economic data. It doesn't matter if there was hopes of Fed pivot, even though there's not actually going to be a Fed pivot. It doesn't matter, right? You've had all of those upside moves get faded out, buy-side liquidity get trapped in the market, and sellers continue to drive us lower and lower here. But what we have to understand as manual retail traders and what we have to adjust our risk psychology and execution to is the pullback phases. Now, what do I mean by adjusting your risk, your psychology, and so forth? Well, secondary phases of market structure, whether it's a pullback, correction, consolidation, whatever you like to call it, it's never as smooth and steady compared to the impulsive moves with trend. Think about it. Here, gold, you did 2,000 pips of downside in pretty much 2 weeks. Here, you did 2,000 pips of downside in 3 weeks. Here, in a month, you're doing 2,000 pips. Another month, you did 2,000 pips down. But in the same amount of time, for half the pips, you're doing these pullback phases. The pullback phases are always a lot more choppy, a lot more hectic, a lot more corrective compared to the impulsive moves with trend. It doesn't matter. The Feds and US economy is damned if they do, damned if they don't. Even if the Feds, let's just say your scenario plays out and they get forced to pivot, even though they said they won't. Then what's gonna happen? They're gonna drop interest rates again, continue to pump the markets, and then hyperinflation will destroy the country. Hyperinflation is a lot more dangerous than a debt crisis. Debt crisis, they can continue to defer the debt and continue to raise the country's debt as it's already in the tens of trillions of dollars. It's already $30 trillion of US debt. But inflation, once inflation's out of control and hyperinflation, the whole country's destroyed. You're going to have a depression. Like, learn some basic economics before you try to come talk to the teacher. You're the student in the chat. I'm the teacher over here. Hyperinflation is way more dangerous than a debt crisis, especially for a major global pillar country like the US. Hyperinflation will completely destroy everything, just like it has for many countries historically before. Germany, post-war era, has still been dealing with hyperinflation. Post-war, post-World War, has still been dealing with bringing down inflation and has been still dealing with the economic downside of that. So nobody wants to deal with hyperinflation. The Feds have cemented a single mandate policy. Even if they do get forced to pivot or something of that nature, it doesn't matter. They're gonna have to raise rates again because hyperinflation will destroy the country anyways. The main reason why gold has been bearish, the main reason why dollar has been bullish, the main reason why GU is bearish, EURUSD bearish, oil bearish, real estate, commodities, crypto is because of the Fed rate hike cycle and dollar domination. Okay? It's that simple. You can hope for a Fed pivot. I'm not. I've been playing the sells on US 30 from 36,000 down. Everybody who hopes for a Fed pivot just gets caught in these waves and ends up being food for the whales. Even if we have a short-term bear market rally, it doesn't matter. Yeah, you might get a short-term bear market rally relief, delusional optimism. You're still going to turn bearish on equities here. You have global recessions developing, weakening economic data, less investment activity with higher interest rates, less institutional lending going on in economic activity, the decade of free money over, whales liquidating positions out, dollar domination. Stop hoping for shit and go with what you can see and understand. Too many people, and I would love to see your trading results on hope. You know what I mean? So anyways, what can we understand here? That majority of the trading instruments that we look at are in secondary phases of market structure. Pulling back from lows, EURUSD pulling back from lows, UCAD having a pullback from highs, US 30 minor pullback from lows, and gold also having a pullback while still maintaining beautiful bearish market structure. Does that quick educational lesson make sense to everybody? Again, we're starting a new business quarter after a very strong impulsive move the last month. We're having some corrective pullback phases against main higher time frame trend, and we're playing those pullbacks accordingly in the short term until we can jump back into the higher time frame bias. From a psychology perspective, we have to understand the markets move in waves. We have to adapt to these market waves accordingly. We can clearly understand when these pullback phases occur. We have to adjust our risk psychology and execution accordingly. Now look here. When you come to look at the intraday time frames, look at the difference between when you're in a main trend move versus when you're in a corrective phase. What we are in right now in yellow is potentially a corrective phase coming up, right? This corrective phase could easily still dig into 1720s, 1730s here and still be very bearish. We could even come to 1720s, start to create a consolidation zone, and then probably drop mid-October where we get more Fed rate hike cycles. But what we have to understand is the price makeup of the different phases. When you're playing with your higher time frame trend and the sellers are in play, it's a lot easier. Straight cut downside, very strong bearish moves, very minimal pullbacks. Every single day you're selling there until you peak a new low. But when you're playing some of these corrective pullback phases, it's not as clean cut. A lot more choppy price action, a lot more consolidation, a lot more indecision until you finally jump back into your higher time frame trend bias. This is what I mean in the psychology tip, that during these secondary phases of market structure, potentially marked in yellow here, that you have to adjust your risk and you have to adjust your execution accordingly. You probably don't have as much probability to be holding trades longer during the corrective phases compared to the impulsive moves with trend. The impulsive moves with trend, you can hold positions for multiple hours, multiple days, potentially even a week, as you're playing with the trend to drive into previous lows and lower lows. But during the secondary corrective phases, even though you're pushing up, you can see some of these sporadic waves, very aggressive intraday pullbacks, hundreds of pips of price whipsaw as you're having that corrective and pullback phase. Does that make sense to everybody? Right? You can see that across the board here too. Look at US 30. The US already can't fund their debt, you fucking retard. You dumbass. The US has 30 trillion in debt. They already can't fund it. They just printed out another 19 trillion last year. The US is all, the US is, you think I don't understand what you're saying, but you don't understand what I'm saying. The US economy is damned if you do, damned if you don't, which I've talked about in educational webinars multiple times. It doesn't matter which way you want the US economy to die. It's gonna crash regardless. The US is already in heavy debt, with debt constantly rising, and debt's been going up in the US for the last 2 decades, right? The central bank's focus is not a debt crisis. The central bank's focus is an inflation crisis, where inflation is a much larger impact than a debt crisis, proven throughout history. I'm not saying that the US isn't going to enter a debt crisis or wouldn't enter a debt spiral. No. I'm saying that the Federal Reserve much rather have inflation combated than and enter a debt crisis rather than increase debt and enter a hyperinflation crisis. Does that make sense to everybody? The US is damned if they do, damned if they don't. They've already increased inflation way too high through monstrous money printing. The US debt is already way too high. You already have a huge economic bubble that the US economy is. The US economy is going to crash one way or another. Either it's going to be a very aggressive hard crash through hyperinflation, or it's going to be a slow and steady bleed through debt continuing to increase. What the Feds are trying to do is a slow and steady long-term bleed. Does that make sense? Does that make sense to everybody? If the Feds pivot and they start cutting interest rates again and stimulating the economy to prevent a debt crisis, then they're going to create a hyperinflation crisis, which hyperinflation is a lot more negative impacting and a lot more of a depression catalyst compared to a debt crisis. Does that make sense to everybody? This is the reason why Feds have said themselves that the Feds have more information than you do. The Feds know that GDP is dropping. The Feds know inflation's very high. The Feds know the economies are in recession, and they're still raising rates. They still said they're going to continue to raise rates. They said themselves, we are not going to pivot. We have to bring down inflation. Their focus isn't avoiding a debt crisis. Their focus is avoiding hyperinflation in an inflation crisis. Debt they can defer. Debt they can continue to manage like they have for the last 2 decades. But hyperinflation you cannot manage once it gets out of hand. You have a full economic reset then. So again, yeah, keep listening to the teacher who has a lot more experience than you and actually understands the current economic environment, as you've been hoping for a Fed pivot, but I'm the one who's been shorting the stock market. Yeah, and if they don't raise rates, hyperinflation will destroy the entire economy in a way more negative fashion than over-leveraged debt. Over-leveraged debt can continue to be deferred. Banks can continue to get bailed out. But hyperinflation will destroy a country as a whole, from the ground all the way to the top. Go study what happened to Germany. Go study Zimbabwe. Go look at Venezuela. Go look at these countries that are dealing with hyperinflation to this day, compared to countries dealing with debt crisis that are in way better shape. You don't understand macroeconomics even the slightest. No shit, if they raise interest rates, debt rates are going to go up. No shit. But they have no choice. They have no choice. Whether you like it or not, I'm following the Feds. I'm not going to guess for a pivot. I'm not going to hope and pray for a pivot. Oh, but the debt crisis and the Feds have to pivot. Well, they haven't yet, right? They haven't yet. No, I'm saying that they need to bring inflation down first. And then once they bring inflation down, then they can do whatever they want after that. But you can't have that if hyperinflation destroys a country first. Then there's no chance of bailout. There's no chance of stimulus. There's no chance of central bank intervention. They can't do anything about it. So stupid. But yeah, anyways, so we're in secondary phases of market structure. GU, Euro USD, gold, US 30, they're all just in short-term pullback phases. Stock market's not going bullish from here. Stock market's not going bullish from here. The Feds are not pivoting in a month. It's not happening. They just had an FOMC where they just said last time we're going to be doing more rate hikes. We're going to be doing a 50 and 75 basis point hike to come still, and we're going to be keeping interest rates up for the next 18 months. You don't think the central bank knows about debt levels better than you do? You don't think the central bank knows about institutions being over leveraged or if they're about to crash? You don't think if that was the main issue, they would have pivoted already? Why would they hike rates? What's the point of hiking rates and then bringing them back down again 4 months later? What was the point of all that? It didn't do anything to inflation. It didn't change anything in the economy. You think you have more information than the Fed? You know better about the country's debt and about institutions being over leveraged than the Fed? You know better? Dorky. You're a dork. Alright? But anyways, everybody. Dollar. Bearish pullback mode. As we've still been playing dollar domination, of course. But it's very, very common as the markets move in waves and you have significant higher highs printed, that you can have these pullback phases. We could have dollar come to 110, even 109, and still be extremely, extremely bullish on the higher time frames, just having a pullback phase correlated to the upside that we saw. Market still maintaining that balance and price integrity. Okay? So the main common theme of this market update webinar is that we are adapting to some secondary pullback and corrective phases of the market until we can jump back into higher time frame trend. That means that I can still see gold potentially coming into the 1720s, 1730s before turning bearish again. I could easily see GBPUSD coming up to 1.16, 1.18 before turning bearish again. I could easily see EURUSD coming up to 1.0 flat, 1.02 before still turning bearish again and maintaining bearish structure. I could see dollar coming down to 110, 109 before going bullish again. Does that make sense to everybody so far? Put a 1 in the chat if everything that makes sense to you so far. Why the markets have been doing what they do, the impact of the Fed rate hike cycle, how the markets move in waves. Inflation is a false narrative. Yeah, okay. Your family's paying double for gas. It's false. We're not done our analysis yet. This is no analysis yet. This is just basic bare bones. Everybody understand the concepts. We're going to dive into the individual pair analysis and trade ideas in a second. We didn't even do the analysis yet. This was just a little bit of an educational reminder portion, educational review portion about market timing, market waves, adapting to market waves, understanding how to play pullbacks and so forth. Okay? Now we're going to jump into the analysis across pairs and trade ideas across pairs. This was just understanding that markets are in secondary phases in pullback structure across the board. Gold is pulling back from lows, GU having a pullback, Euro USD, USDCAD having a pullback, US 30 as well. And we are going to be adapting to those waves accordingly until we jump back into the higher time frame main trend bias. So now let's jump into the actual analysis and everything of that nature and so forth. So right now, for the example of when we're looking at gold, in my opinion, gold can still dig into the 1710s, even into the high 1720s before seeing any major further sell-off. Right? We might have some minor pullbacks to revisit some of these broken liquidity zones, turn into a buy area. But I can still see some short-term upside if we hold above the 1680s into the 1710s or 1720s before seeing sell-off. But we just want to understand what economic events we have on the table and key price points of interest that we're looking at as well. This trend line is just a visual representation of some of the minor structure we're looking at here. Okay? I didn't say the Fed is going to do a bailout while doing quantitative tightening. I said the Fed's first focus is inflation, not debt. If you guys were right and the Fed's first focus was debt, then the Feds would not have been raising interest rates to combat inflation. The Feds want to bring down inflation first before they deal with anything else. That's all I'm saying. That's why we've been seeing an active rate hike cycle. That's why we've been seeing US dollar so strong. That's why gold's been so bearish. Even no shit, the US has more debt than it did in 2008. Every country has more debt than it did 10, 15 years ago. That's not the issue. Debt isn't the primary concern of the US government, of the corporations, or of the Federal Reserve. The primary concern is inflation. Otherwise, if you were right, they wouldn't have been raising interest rates over the last 7 months. We wouldn't have dollar so bullish. We would have dollar a lot more bearish. You guys are wrong. And you can prove you're wrong by looking at the chart. If the Feds were pivoting, if interest rates weren't high, stock market would be bullish right now. Dollar would be bearish. Gold would be way more bullish on the higher time frame. But it's not. Gold went from 2,000 to 1,600. Stock market went from like 37,000 to 29,000. Dollar's gone from like 108 to 114. Right? So I do understand that this isn't 2008. But I'm not a retard who's fighting the Feds or hoping for something else. It is common sense that the US has more debt now than they did in 2008. Debt only increases. They don't pay back their debt. They live off debt. They use debt as a financial system. So debt has never been a major issue. The major issue is potentially the 19 trillion that was printed out that can lead to hyperinflation if it's not managed and the supply isn't regulated and interest rates aren't raised. Yeah, now what? What are you going to say about that now? Brexit shut the fuck up because he has nothing to say. He knows he's wrong. He shut the fuck up now. Now it's your turn. Please let me know what you think about that now. How many FOMCs do you need to see that they're trying to bring down inflation? How many interest rate hikes do we need? How many times do the Feds need to say that they're not going to raise rates and cut them again right away? How many times? How many times are you going to keep fighting that? How many times are you going to fight the Fed and get knocked out? Why? Exactly. Doesn't make any sense. You know what I mean? Okay, before we jump into the gold trade ideas, we just want to understand what economic events we have on the docket. So, not much going on tomorrow. Not much going on tomorrow. So, we just have some producer inflation prices from Eurozone at 5 a.m. Eastern overnight. won't have that much impact. Then tomorrow at 10 a.m. Eastern during the North American trading session, we have monthly factory orders and JOLTS job openings. Monthly factory orders is expected to show a rebound coming out of negative integers, going back to 0% flat, which can be taken as short-term optimistic. If JOLTS job openings is still showing us the labor market is robust and factory orders is showing us any rebounding, that can be a potential reason to get some gold rejections at higher time frame sell zones and price sensitivity areas of interest. But this is what I'm going to be primarily looking for to show all of you people and individuals for this next daily candle. If we have pullbacks to these areas and failure to break or hold above these areas, I'm going to be looking for short-term pullback buys up to retest better sell zones on the higher time frame. Looking at 1708s and 1715s. Otherwise, safer sells on gold at this point would be well below 1670s after having rejections from the highs. So remember, markets are in secondary phases of market structure, having pullbacks and price setups for the new business quarter. Gold can still dig into the higher 1700s, low 1720s. Short-term buys up to retest better sell zones on the higher time frame. So I basically see us squeezing deeper into this area here where you have this order block, or squeezing deeper into this area here. Right? So the short-term buys up to that point. So according to Jeeve, the government can pay off debt with borrowing more debt. No, nobody said that. Nobody said that. Debt gets deferred. Debt gets continuously stacked up over the last 20 years. You're wrong. You're still wrong. The US hasn't paid back debt from World War. They haven't paid back debt from the GFC crisis. They haven't paid back debt from the dot-com era crash. They haven't paid back any debt to this day. Debt just continues to increase. Debt is not the primary focus. Inflation is. There's your answer. What do you mean? The government already can't fund their debt. It's $30+ trillion. They already don't pay off their debt. $30 trillion, I was right. U.S. national debt continues to, none of this is getting paid back debt. Look at the total unfunded, debt and interest. And look at the money creation. These are all in the negatives. None of this is getting paid back. You don't understand that. Like, what don't you understand? This isn't the focus of the central banks, of the corporations, of the 1%ers. This has never been the focus here. No, it's not mandatory. The legislation and the government can defer and make whatever policies they want to cover themselves, like they have over the last years. What do you think increasing the debt ceiling is? What's increasing the debt ceiling? Huh? What is increasing the debt ceiling do? The US Congress, the legislation Congress, has raised the debt ceiling 14 times from 2001 to 2016. You're getting fucked. I'm raping you with knowledge. The central bank is not focused on debt. The corporations aren't focused on debt. The government isn't focused on debt. They've raised the debt ceiling 14 times in just 15 years. You're fucking embarrassing yourself. That's why interest rates keep going up. You're wrong. 100% wrong. Can't be more wrong. If you were right, then dollar wouldn't be bullish right now, would it? You said, oh, but it's legislative spending. It's mandatory to pay your debt. And if it gets too high, you're going to hit the debt ceiling. They raise the debt ceiling. They raise it. They increase the debt ceiling. They say, okay, it's higher now by 2 more trillion, by 10 more trillion. We increase the debt ceiling. Now what? They did it 15 times in the last 15 years. Now what? They can't do it again? You're wrong. You're saying shit that doesn't even make sense. You got owned. The Federal Reserve's focus is not debt. The Federal Reserve's focus is not paying back debt. The Federal Reserve's focus is making sure hyperinflation doesn't happen. The Feds have been raising rates to combat inflation. There's been no pivot. They're not going to raise rates for 6 months and drop them again. There's no point in that. I already answered all your questions in exact detail. And the market impact has been going on with that. You know what I mean? It doesn't matter to me. I got time. I'm like fucking rich. I can do whatever I want. Yeah, you're wrong. Everybody in the chat's telling you you're wrong. I'm telling you you're wrong. The charts, the dollar chart is telling you you're wrong. If I'm wrong, okay, what about the dollar chart? The dollar chart's wrong too? This is wrong right here. This bullish rally on the dollar, that's wrong. That's because they're focusing on debt rates. That's because interest rates are so low. That's why the dollar's so bullish for the last year. The chart's telling you you're wrong. The numbers are telling you you're wrong. The Feds are telling you you're wrong. The US government's telling you you're wrong. The dollar chart's telling you you're wrong. Stock market's telling you you're wrong. Like bro, let your ego go and just play on the right side. Right? You're wrong. No, I'm just marking out the gold trade ideas again. Short-term pullback buys to better higher time frame sell zones. No, I already spent like 20 minutes answering your questions. You want to ignore what the dollar's doing. You want to ignore what the central banks are doing. You want to ignore what the stock market's doing. You want to ignore all the information I said, and you keep saying I didn't answer your question. Everybody else says I answered your question. Everybody else understands fine. You're the one who's fighting yourself, but I don't mind. It's entertainment. The longer I run the stream, the more views it gets. The more you type in the chat, the more interaction I get. The higher the chat rate, the better for me. YouTube doesn't know if you're typing troll comments or typing good comments. It just counts a chat rate. It doesn't matter to me. You know what I mean? This stuff is interesting for me. I love talking about economics because I have experience in it. I've studied it. I have understanding in it. I have people pay me for it. Where you're in a YouTube chat coming to watch me. And every week you come to watch me. Every week you come as soon as the webinar is live. You go on your computer or your phone. You come and say, damn, Jeeves live right now. Let me go see what he's saying. Let me go type in his chat. I don't mind. I do not mind. You know what I mean? Now, on GBPUSD, right? And on EURUSD. Oh, Kerwin. What's up, Kerwin? On GBPUSD and EURUSD, I can still see some short-term upside squeezes to retest better sell zones on the higher time frame. On GU, I'm roughly looking at coming around 1.45, 1.5 area flat before starting to see any type of more major sell-off. Yeah, you guys notice I don't ban anybody. I just let the trolls keep talking. I entertain them because it's better for my interaction. It's just numbers for me. It's my stream. These are my views, my comments, my channel that you're spending your time on. Right? Really think about that inside. Really think about that. And if you think I'm so wrong, if you think I'm so bad, why do you come listen to me every week? Why do you come listen to me every single week you're here? Like, what does that make you? It makes you my fan. You know what I mean? So if every single week you're here, every single week you think I'm wrong, but every single week my analysis continues to play out and I continue to make money, you're probably fighting on the wrong side, getting raped. Just admit you're wrong and come on the winning team. Just come on the winning side of the market. You could have been playing the dollar bulls with us this whole time, this whole year. You could have been playing dollar bulls with us in gold sells. Instead of, like, you know what I mean? Fighting that the feds are going to start to bring down debt. Instead of hoping about them bringing down debt, even though they've said zero about that. You know? Did we talk about the events? Yeah. So just euro inflation and just U.S. economic data, 10 a.m. Eastern tomorrow. We might see some rebounds with factory orders and JOLTS job opening. But something we do have to keep an eye out on. Kerwin. I don't mind. I'm not getting distracted. This is like, listen, I gotta tell you guys something. I do this analysis and trade ideas and information for the community. I know what I'm looking for trade ideas analysis. I know what's going on in the markets. I know what to look out for. I'm not distracting myself at all. I'm just interacting with the YouTube chat during a YouTube live stream, right? There's a reason I put the chat on. I could just turn the chat off if I really wanted to and could just give some analysis, but then it's not that fun. It's really boring for me. I like to talk with the trolls. I like to prove them wrong. I like to let them know they're my fan. I like to let them know that they're spending their time and effort on me. I like that. It makes me feel good inside. You know what I mean? Like that shit low-key feeds me. And people think they're like, oh, he's getting angry. He's getting so annoyed. No, I'm not. If I was getting angry, I wouldn't be doing the stream. I would just turn it off. You know what I mean? So I don't mind. I like it. It feeds me. It makes me feel good. It makes me feel like it's a good feeling that you know somebody that hates you is tuning into you every single week from somewhere across the world just to watch what you're doing. To me, that's a good feeling. You know? Yeah, we just have to watch out from some ECB speakers and Fed speakers tomorrow. We have some ECB speakers with just the vice president talking in a meeting in Luxembourg. And then tomorrow morning, we have a bunch of Fed speakers from 9 a.m. Eastern all the way until 1 p.m. Williams, Logan, Mester, Jefferson, and Daly. So maybe they can bring some hawkish remarks back and turn gold bearish again. But I'm still going to be looking for first some gold pullback buy plays to set up into better higher time frame sells. All right, we got another person. Jeev, I'm with you, but you're wrong about something not breaking in the system. If the goal is price stability and lowering inflation, which is skyrocketing, and controlling that without... Who said the economy's not going to break here? When did I say the economy is not going to break, or there's not going to be a break in the system? Huh? When did I once say the US isn't in a recession, that the economy isn't weak, that the economy isn't going to break? I literally said maybe for the 10th time right now. The US economy and the feds and the US government and central bank are damned if they do, damned if they don't. You know what that means? That means if they don't focus on combating inflation, that inflation will continue to go out of hand, and that will crash the economy. But if they continue, but even if they do raise rates and bring down inflation, you're still going to have extremely high debt rates, extremely low economic activity, and still an active recession regardless. The US economy is in a recession and going to get in a worse recession regardless. But the feds are avoiding an inflation crisis, and that's their primary focus. Does that make sense to everybody? The Fed doesn't care if the US goes into a recession in the short term. They're willing to sacrifice short-term quarterly GDP drops. They're willing to inflate the value of the dollar in the short term as well over this last year. But you're saying the goal is to bring price stability, aka control inflation. At some point, QE is going to come because the system will break. It will saw no effect to hyperinflation. Holy fuck. I'm not saying the goal is bringing down inflation. I'm not the Federal Reserve, you dumb motherfucker. I'm not Jerome Powell. The Federal Reserve over the last 7 months has been saying they're gonna combat inflation. That's their focus. They're the market maker, not me. I've just been following them. If the feds decide to pivot and then they decide to do QE again, who do you think's going to be the first one to ride that wave? If the feds say, you know what, the system's going to break and we have to do QE, we can't keep raising interest rates, I'm going to be the first one to sell the dollar and to buy gold and to buy the stock market with inflation going back through the roof. But I'm not the one saying that we have to focus on price stability. It's not me, you fucking retards. I'm not the guy. Do you understand that? Jerome Powell in the Federal Reserve, at every single Fed interest rate decision over the last 6 months, has been focusing on that. Right? That's what the focus is. I didn't say the US reached hyperinflation. I didn't say that. I said the US is at high risk, very high inflation, where if they didn't do anything to bring it down, it can go to hyperinflation levels very fast. Right? Just because we're at 10% now doesn't mean you can't jump to 20, 30% in a very fast accelerated rate. I'm not wrong. You're wrong. Look at countries like Venezuela. Look at Sri Lanka. Sri Lanka has jumped up month over month 20%, 40%, 50% inflation. Just in a few months, just in a 5-month span. Look at Venezuela. Look at Zimbabwe. You don't reach hyperinflation in a short period, in a long period of time. It hits you like a freight train. So I'm sorry to tell you, I'm not the US government. I'm not Jerome Powell. I'm not the one who's deciding that we're going to bring down inflation. I'm not the one raising interest rates. I'm the one who's following the Fed because the Federal Reserve is the market maker. Now, let me ask you a question to everybody in the chat right now. Has the Fed pivoted? Has the Fed done QE yet? Yeah, but did the Fed, first of all, did the Fed pivot and do more QE right now? Is the Fed pivoting and doing QE? No. Is the Fed cutting interest rates? No. What is the Fed doing right now? Raising interest rates. Why are they raising the interest rates? Because their primary goal is bringing down inflation. Is the US at hyperinflation? No, they're not. But they're at very high risk inflation for the current economic situation of their country. You're fucking stupid, bro. Go message the feds. Go send them an email. Say, hey, how come you guys aren't pivoting? How come you guys aren't doing QE? You guys aren't at hyperinflation yet. Do QE. Go fucking email Jerome Powell. Why are you telling me? Yeah, relentless trading actually just summarized in one sentence, in a couple of sentences, exactly what I want to do. Yeah. If Fed continues to raise rate, dollar will get stronger, gold and all these other classes will drop. Then you buy it more when Feds do pivot, when they eventually do, maybe a year and a half, 2 years from now. I don't know. But I'm not going to be guessing and hoping for Fed pivot. I'm not going to be messaging Jerome Powell saying, hey man, you're not at hyperinflation yet. Why don't you do some more QE? We have more, we can get inflation higher. Do some more QE so my Bitcoin goes up. Come on, man. Shit, man. It's okay, relentless trading. You said a very smart thing. I liked your comment. Yeah, this guy keeps saying, you keep talking about price stability being the main focus. You keep talking about bringing down inflation. No, I'm not. Not me. That's the cartel of the currency. That's the central bank doing all that. All right? It's not me. I'm not the one focused on price stability. I'm not the one focused on raising interest rates. I'm not the one keeping interest rates up. That's not me. I'm sorry to bring it to you. All right? Okay, how about this? Let me show you something. That's not my choice. Right? Them keeping interest rates up until peak rates 2023 and then keeping rates up, that's not my choice. The feds have said themselves, I don't even know if it'll come up. No hump in rate path. Do you know what that means? That means as they raise interest rates, they're not going to bring them down again, making a hump path of rate hikes. It's not going to be a hump. They're not going to raise interest rates, keep them up for a little bit, and then bring them down again. They have to raise rates and then keep them up for an extended period of time and then do any QE or pivot. This isn't my words. This is from FOMC, from the Fed speakers, from the Fed interest rate decision, from Jerome Powell. Right? This is not me about keeping rates high. It's not my choice. I'm just telling you guys what's been happening over the last 6 months. Why dollar's been so bullish. Even with financial conditions, even with stock market down, even with costs going up, they still want to keep it tight and keep interest rates up. You know what I mean? So yeah, it's not my choice. I'm not the one running the mandate policy. I'm not the one focusing on bringing inflation down. I'm just the one following the feds. Yeah, these guys kept saying, you keep talking about focus on price stability. You keep talking about bringing inflation down. No, it's not me. I'm not the person doing that stuff. I'm just following what the feds are doing. Yeah, they're acting like I'm the one making all these policy decisions. Like I'm the one who's behind any Fed pivot potential. What the fuck? I wish. Listen, if I was a Fed member, I would not be here in this YouTube stream. I'd be filthy. I'd be filthy rich with all the insider trading I would do. You know what I mean? I would not be here right now doing this YouTube stream. EURUSD, same idea. Short-term pullback phases to better sell zones of interest on the higher time frame. I wish you guys should nominate me to be a Fed member. I'll send you guys all insider secrets. Yeah, you wouldn't be allowed to stream like this. But I'll send you guys like insider secrets in like a secret like Telegram chat. Submit my name to be a board member. Don't worry about the trend line on UCAD. I can see deeper sell plays to set up better buy areas. Yeah, that GBP chat of traders together. Those London traders. Is that what you're talking about, Mehmet? Does Powell have a son? Jay Powell has a son? Okay, so this is a long ass webinar. I might just delete this webinar. Fuck all you guys, to be honest. I'll just do another market update for the private channel in a Zoom chat. I don't care. I'm just gonna delete this webinar. I'm not gonna save it after. I'm just joking. Okay, so to summarize, I can do whatever I want. It's my channel. What do you mean? That was delete the video. So to summarize, gold pullback buys to better sell zones. Okay? GBPUSD pullback buys to better sell zones on the higher time frame. EURUSD pullback buys to better sell zones on the higher time frame. US30 pullback buys to better sell zones on the higher time frame. USDCAD inverse pullbacks to retest better buy zones on the higher time frame, which I'm more seeing if we can either come to retest 1.34, last previous significant intraday high, or 1.331. Last but not least, GJ, I'm in a bullish bias. GJ, I'm looking for retests of 162.5, retests of 161, breakouts above 164, continued buys. Shit, I gotta go to the grocery store before this one closes in an hour. It's already 6 p.m. Shit, man, we've been talking for an hour here? You guys wasted my fucking time. Oh, man. We were ranting for an hour about that Federal Reserve stuff, eh? People are so stupid, man. Fed pivot, Fed pivot, Fed pivot. Okay, keep buying more Bitcoin then. Go buy the stock market. So again, to summarize everybody, we're having the start of Q4 price setups. Markets in secondary phases of structure. Corrective pullback in consolidation phases. The macro information of central bank policies is still holding the most weight. We have a lot of economic data this week. Minimal geopolitical tensions. Psychology tips, the markets move in waves. We have to adapt to the market waves accordingly. Pullback / price setup phases to start the new quarter. Adjust your risk, psychology, and execution to market waves. Keep an eye out on the higher time frame analysis price points of interest. Gold, we're in pullback from lows. GBPUSD, we're in pullback from lows. EURUSD, we're in pullback from lows. US30, we're in pullback from lows. USDCAD, we're in pullback from highs. We can see gold potentially coming for some short-term buys and doing pullbacks to the 1710s, 1720s before we continue bearish again. We can also see, wow, Canelo, after all that government stuff, you're asking why gold had a rally? What a retard. Everybody flame this retard. GBPUSD can come up to 1.15 still before turning more bearish again. EURUSD can come up to 1.10 flat, 1.102 before turning more bearish again. USDCAD can come down to 1.34, 1.31 before buyers come back into the scene. US30 can pull up all the way to 31K flat, 3,600 before sellers jump back into the market. GJ, we're overall still bullish. Okay? Joe Day Trades. Jeev, what do you think about CBDC, XRP, and how will that play out with Forex? The central bank digital currencies will be no different than the current monetary financial system, except everything will be digital, further audited, easier tracked, and easier accessible. But the digital currencies will still be under central bank control. They'll still be following the same monetary policy setups. It'll still be based on the same financial system roots, because you can't really change the whole structure of the financial system by shifting the currencies. So the digital dollar is going to be no different than the paper dollar setup, except digital. You know what I mean? Yeah. I heard it's supposed to be maintained on an XRP ledger, but yeah, it's still not going to be any different than the current financial system, except way easier to track your money. A cashless society is like even easier to track your money. You know? Some people are new to the market. No need to be toxic. Nobody's toxic. I'm still here. My phone died. This guy charged his phone and came back quick. Yo, is he done yet? I'm still here. My phone died. I'm still here. My phone died. You're completely wrong about the Fed pivoting. Joy pivoting our financial system flourishes and performs the best when there's free money. Okay, man, but the Feds didn't pivot yet, all right? So the Feds didn't pivot yet. So that didn't happen. So you're wrong right now. Over the last 6 months, they've been raising interest rates, saying they're not going to pivot, that they're keeping interest rates up, that they're focusing on price stability, that they're focusing on inflation. That's what I've been following. That's what I've been trading. That's what the market's been following. That's why dollar's been so bullish. If they pivot, they pivot, but they haven't yet, and they haven't said they will yet, and they didn't yet. What else do you need? What else do you need to know? Man's phone died. So you know scrambling for the charger? Fucking bastard. Fucking bastard talking to me. Come on, turn on. Go back to the YouTube stream. Oh fuck, man. You could have just like not come back. You could have just let your phone charge fully, bro. It's not a big deal. This guy's like, I didn't go anywhere. My phone died. I'm back again. Okay. And thank you for coming back again. Like, what do you want us to say? Shit, man. You guys are fucking hilarious. Oh, shit. That was funny. Okay, so very long stream today. You guys can rewatch this as you wish. I gotta go do some grocery shopping, chores, and go to the gym after. I think I gotta go get an x-ray too. I think I tore a ligament in my shoulder. I can't really raise my arm that high or hold it high right now. You know what I mean? Oh, Norbert with the donation. Thank you. If you want to troll and not have a serious convo, coming from a guy who's talking in my stream, viewing me being my fan, when I've given full fundamental breakdowns on the rate hike cycle, on Federal Reserve, on central banking. I even did an educational webinar recently on central banking. You're just some random stranger. Send us your social media. Let's go look at you right now, Brexit. No, everybody, before we go, Brexit, send us your social media. Let's see what you look like. Let's check you out. Let's check your information and all the stuff that you do for everybody. Come on, let's see it. Come on, Brexit, Big Mac Sauce, the other guy. Send us your IG. Send us your @ Let us see everything you do for the community. Let us check you out. I'm here every single week on Instagram, Twitter, Telegram, YouTube, publicly, showing my face, putting my balls on the line, giving information to the public, validating that information, sharing trades, sharing information for 3+ years socially right now, for free and for paid. I'm on Snapchat. I show myself, my face, my analysis, my trades, accounts, process, analysis, information, fundamentals, technicals, short videos, long videos, webinars, informationals, market reports, economic reports. So now let's see you. Nah. Send us your IG. Don't be scared. Don't be shy now. Send us your socials. Let's see. I'll pull you up right now. Come on. Exactly. Go back in your dirty brown Fruit of Looms underwear. Wipe the Cheeto dust off your shirt. Clean the sweat from under your pits. And go back to jerking off after this stream. Because you can't touch me. Alright? Alright, everybody. Take care. Have a great day. Yeah, sure. 100%. I'll debate you live on social media if you show your face. Send your socials right now. I agree. I agree to debate you live on social media. Send your social media right now. Send it. As long as you show your face and promise, send it in the chat right now. Prove you're a man. Put your balls on the line. I agree to debate you live on Instagram right now. Both of us showing our face. Both of us giving us a chance to talk. Talking about economics and what's going on in the world. Yes, I agree. Be a man and now show me, put your balls on the line. Let's go. Let's go. I agree. I'm telling you right now, I agree. I'm down. 100% I'm down. Your phone didn't die right now. Come on. Send it before this live ends. Let's go. Send it to everybody in the chat. We need the proof. You just called me out to debate economics live on stream. I agree. I am down. I am very interested. I accept your challenge with open arms, ready to go right now. Right now. Where'd he go? Yo, everybody, where'd he go? We'll give him 30 seconds. Otherwise, he's going to be known as the community bitch. Nobody DM'd me yet. Nobody DM'd me. Let me check my phone. Let me check Instagram. Nobody blocked you. What? Just send your socials right here, you liar. Send it in the chat right now. And then we can all pull up and watch. Come on, just send your socials in this chat right now. And then we'll go run the debate. I'll talk about economics with you live. We'll talk about the current economic situation. He didn't send it to me one-on-one either. I'm on Telegram, WhatsApp. Okay, send it to me on Telegram right now. Send it to me on Telegram then. I'll be waiting. I'll confirm to everybody that you DM me. I didn't get nothing on Instagram, nothing on Telegram, and you're not blocked. Yeah, no messages. No messages on my Instagram from this guy. Nothing. No messages on my Telegram, nothing. I guarantee he's not going to challenge me. I guarantee it. Because he's wrong. All these Fed pivot mans are wrong. It didn't happen yet. Yeah, no no Instagram message, no Telegram message. I didn't get anything. So I guess he doesn't want to have that live debate. You can't message me on Telegram. Message me on Instagram then. No, I'm actually interested in the debate. It's not like an argument or anything. I'm actually interested in economic debates. If anybody ever wants to have one with me, I'm always interested. Always interested. We can do it live on Instagram, have a discussion, showing our faces, talking about whatever you want to talk about in global economies. Anybody can message me to do that. Can you message me? Is it a request? Let's go live. About macroeconomics, you're misinforming people. Let's go live. I'm gonna save and upload this, and then I'll wait for you to go live. All right? Join my live on IG.